Hello everyone, welcome back to the channel where we talk about mortgage and money. If you are a first-time home buyer and wondering how much money you need to save for down payment, well, you have come at the right place. In this two-part series, we'll talk about the minimum down payment requirements and also explore whether it makes sense to pay a 20% down payment or should you go for a 5% or a 10% options. Let's get started. The minimum down payment really depends on the purchase price of the house. If the house you want to purchase is less than $500,000, the minimum down payment is 5%. For the houses priced between $500,000 and less than $1 million, down payment is calculated as 5% of $500,000 plus 10% on the remaining amount. Priced $1 million and above, down payment is 20%. Let's simplify it further with few examples. Let's say you like the house which is listed for $400,000. In this example, your down payment will be 5% of the purchase price, which is $20,000. Or if a house is listed for $700,000, then your down payment will be $45,000, which is calculated as 5% of initial $500,000 and then 10% remaining $200,000, which comes out to be $45,000 of your. If you're in the market for a mansion which is priced at $1.2 million, your down payment is pretty straightforward. It's 20% of your $1.2 million, which comes out to be $240,000. But there's a catch. If your down payment is less than 20%, you need to get a mortgage default insurance. What is the mortgage default insurance? Well, as the name suggests, it's kind of a security for your lender. In case you default on your payments, your lender can go to this insurance company and get the money. One thing to keep in mind, it protects your lender or the bank who has given you the money. It does not protect you. And as with any insurance, there is a premium attached to it, which you need to pay. But you don't have to pay that premium upfront. In a typical practice, banks will calculate the premium and add it to your mortgage amount. And that's a total money they will lend to you and you pay back over the mortgage duration. There are also taxes associated with this premium which you have to pay upfront as a part of your closing costs. How do the banks calculate the premium? The premium is calculated as a percentage on the loan amount and it depends on your loan to value ratio. Let's go back to our example where the list price was $400,000 and down payment is 5%. In this example, your loan to value will be 95%. And from the table, we can see that a 4% premium needs to be applied on $380,000, which is the money you are borrowing. And it comes to around $15,000. Now, banks will add this $15,000 to your initial request of $380,000 and come up with a new amount which they're going to lend to you. And you will pay on the interest of this total amount. So to summarize, your minimum down payment really depends on the purchase price of the house. It starts with 5% for houses below $500,000 and goes all the way to 20% for $1 million plus houses. And if your down payment is below 20%, you need to get a mortgage default insurance.